Imagine a trader buys a call because they like a stock, then immediately sells some shares against it. That sounds backwards, until you realize the option is not just a yes or no bet on direction. Professionals often care about shaping risk very precisely, and delta hedging is one of the main tools they use to dial down directional exposure without getting out of the options position itself. To make sense of that, we have to start with delta, because delta is the bridge between an option contract and the stock exposure hiding inside it. Delta is the option Greek that estimates how much the option price should change when the underlying stock moves by $1. A plus 0.40 delta call is not the whole position, but it is a very useful first estimate of directional sensitivity. That is why traders treat delta as a bridge between an options contract and the stock exposure hidden inside it. One standard equity option contract usually represents 100 shares, so a 0.40 delta call acts like roughly 40 shares of stock exposure. That does not mean the option becomes stock, but it gives traders a practical share number they can hedge against. This is the simple example beginners should remember. 0.40 delta times 100 shares equals about 40 shares of exposure. If a trader is long one call with about plus 40 deltas, they can short about 40 shares to move closer to delta neutral. If they are short that same call, the direction flips, and they would buy about 40 shares instead. In some markets, the hedge is done with futures rather than stock, but the idea is the same. Offset small directional moves. Long option traders may hedge because they want volatility exposure, event exposure, or convex payoff potential without a big stock direction bet. Short option traders may hedge because they are collecting premium, facilitating client flow, or managing inventory, and do not want a one-day stock move to dominate results. That is why market makers, volatility desks, structured product teams, convertible bond desks, and event traders all watch delta so closely. Delta hedging is not the only way to trade options, and for many beginners, it is not the first structure they should learn to use. Covered calls, cash-secured puts, debit spreads, protective puts, straddles, and iron condors all solve different jobs from a dynamically hedged book. The clean mental model is goal first, hedge second. Decide whether you want direction, income protection, or volatility exposure before adding a hedge layer. This explanation uses small, clean examples, but real trading adds friction. Transaction costs, bid-ask spreads, borrow availability for short stock, contract size, and fast price gaps can all make a textbook hedge less precise. The key signal to watch is not whether a position was hedged once, but how often it needs adjustment and which risks are still driving profit and loss after direction is reduced. The cleanest way to think about delta hedging is that it is not a standalone replacement for option strategy. It is a layer of risk control. If your goal is a simple, defined risk bullish view, a call spread may be easier to understand and maintain than a dynamically hedged position. If your goal is income, a covered call or cash-secured put has a very different trade-off from running a delta-neutral book. Delta hedging matters most when the job is managing exposure continuously, especially for traders focused on inventory, volatility, or event risk, rather than a single static directional opinion.